For decades, trillions of dollars moved through the global financial system based on a single letter. Not a contract, not a guarantee, just a letter. A, B. Think about that for a second. Your pension fund, the money you're counting on to retire, was being invested based on whether someone stamped AAA or BBB on a piece of paper. And if you asked anyone managing billions of dollars why they trusted these letters, they'd tell you something remarkable. They say they didn't need to understand because someone else had already done the math, someone objective, someone rigorous, someone who had no reason to lie. The system promised three things: safety, objectivity, and mathematical certainty. And for a very long time, it delivered exactly that. Pension funds in Norway bought securities they'd never analyzed themselves. Insurance companies in Japan invested in American mortgages they'd never seen. All because of a letter. All because someone said it was safe. In 2007, more than 60,000 mortgage-backed securities carried the highest possible rating, AAA, the same rating as US Treasury bonds, literally the safest investment in the world, backed by the full faith and credit of the United States government. 18 months later, 90% of them were junk, not just downgraded, worthless, completely, utterly worthless. But here's what almost nobody talks about. The ratings weren't wrong because of a mistake, and they weren't wrong because someone didn't know better. They were wrong because the system worked exactly as designed. Every incentive, every rule, every process was followed to the letter, and almost nobody questioned it because the system said they didn't need to. That's the part that should terrify you. Not that it failed, but that it failed while doing exactly what it was supposed to do. To understand why the system was trusted, you need to understand what existed before it. In the early 20th century, if you wanted to invest in a company, if you wanted to buy a bond from a railroad or a municipality, you had one option: do the research yourself. Imagine you're a school teacher in Kansas in 1905. You saved up $200 and you want to invest it. Someone tells you about a railroad company in California issuing bonds. They promise 6% annual interest. Sounds good, but how do you know they'll actually pay you back? You would have to get on a train, travel to California, visit their offices, demand to see their books, understand their finances, calculate their debt to asset ratio, project their future revenues. And you're a school teacher, you don't know how to do any of that. So you don't invest. You keep your money in a bank account earning 1%, or you stuff it under your mattress earning nothing. Multiply that by millions of people, and you have an economy where capital can't flow, where good companies can't get funding, where small investors stay on the sidelines. The market was fragmented, opaque, locked to anyone who wasn't already wealthy or connected. Wealthy people could hire analysts, they could send investigators, they had connections to company insiders, but regular people, they were shut out completely. This was a massive problem because America was growing fast. Railroads needed capital, cities needed to build infrastructure, factories needed expansion funding. But how do you get a school teacher in Kansas to fund a railroad in California? You need something that bridges the knowledge gap. Then in 1909, a man named John Moody published the first bond rating manual. The idea was breathtakingly simple. Instead of every investor doing the same analysis over and over, one firm would do it once. They'd assign a letter grade, and investors could use that grade as a shortcut. It wasn't perfect, but it was better than chaos. Moody would analyze a company's finances and say this bond is AAA, very safe, or this bond is C, very risky. And suddenly that school teacher in Kansas had information she could use. She didn't need to understand railroad economics. She just needed to know that Moody said it was safe. And it worked. Moody's ratings became trusted, then copied. Standard & Poor's, Fitch, the big three. By the 1930s, regulators began writing these ratings into law. Banks were required to hold only investment-grade bonds. Pension funds could only buy securities rated above a certain threshold. Why? Because someone had to draw the line between safe and risky, and the government decided to let the rating agencies do it. It made sense. The agencies weren't selling the bonds, they weren't managing money, they had no stake in whether you bought or sold. They were just analysts, referees, independent observers. And for decades, this system worked. When a company wanted to borrow money, they'd hire a rating agency. The agency would analyze their finances, assign a grade, publish it. Investors use that grade to decide how much to pay. Higher rating, lower interest rate, lower rating, higher risk, higher return, simple, transparent, functional. Through recessions, expansions, crises, the ratings held up, not perfectly, but well enough that by the 1990s, no one questioned the premise anymore. The ratings had become infrastructure. If you were managing a pension fund in Ohio, you didn't need to understand derivatives, you didn't need to know how mortgage-backed securities worked, you just needed to know the rating. And if someone asked you why you trusted it, you'd say, because everyone does, because the system had earned it. On paper, it worked perfectly, but then something changed that would break everything, and it started with the question nobody thought to ask. How does a rating agency actually decide what grade to give? Let's start with something simple. A corporate bond. Company X wants to borrow money. They want to issue bonds to investors, but investors won't buy those bonds unless they know the risk. So Company X hires a rating agency. They pay a fee, usually a percentage of the bond's value. Could be $50,000, could be $500,000, depends on the size of the deal. The agency assigns a team of analysts who request financial documents, income statements, cash flow projections, debt levels. They build a model. The model asks, based on this company's revenue, expenses, and debt, what's the probability they'll default? If the probability is low, say less than 0.5% over 10 years, they might get a AAA rating. If it's moderate, maybe 2%, they get a BBB. If it's high, 10%, 20%, they're junk, BB or lower. The agency publishes the rating, investors see it, the market prices the bond accordingly. This process worked fine when you were rating General Electric or Coca-Cola. You had years of data, predictable cash flows, it was quantitative but grounded in reality. GE had been around for decades. You could look at 50 years of financial statements. You could see how they performed in recessions, in booms, in wars, in peacetime. The analysis made sense. But then Wall Street started creating new products, not corporate bonds, not municipal bonds, structured products. And this is where things get interesting because the innovation here was genuinely clever. Here's how they worked. A bank makes 1,000 home loans, mortgages. Let's say average loan size is $200,000. That's $200 million in mortgages total. Now here's the problem. Each individual mortgage is kind of risky. Maybe the borrower has okay credit. Maybe they put 10% down. Maybe they have a stable job. But there's still a chance they lose that job, can't make payments, default. If you're a conservative investor, like a pension fund, you're not going to buy one random mortgage from one random person, too risky. But what if instead of selling you one mortgage, the bank sells you a tiny piece of 1,000 mortgages? Now you're diversified. If one person defaults, you barely feel it because you own 999 other mortgages that are still paying. This is actually smart. This is what diversification is supposed to do. It's the same reason you don't put all your money in one stock. But Wall Street took this idea and supercharged it. They didn't just bundle the mortgages. They sliced the bundle into layers, tranches. Imagine you've got that pool of 1,000 mortgages generating, let's say, $15 million a year in payments. The bank creates 3 tranches. Tranche A gets paid first, $8 million a year. Tranche B gets paid next, $5 million. Tranche C gets what's left, $2 million. Now if some mortgages default, who loses money first? Tranche C, they're the bottom layer, they're the shock absorber. Tranche B only loses money if so many loans default that Tranche C is completely wiped out. And Tranche A, the senior tranche, only loses money if the defaults are so catastrophic that both C and B are gone. Think about what this means. Tranche A is protected by $70 million worth of lower tranches. For Tranche A to lose money, 35% of the underlying mortgages would have to default. And historically, that never happened. In a normal year, maybe 1 or 2% of mortgages default. Even in a bad recession, maybe 4%. 35%? That would require something apocalyptic. So the rating agencies looked at Tranche A and said this is safe. Safer than a corporate bond from a solid company. Because even if the economy tanks and defaults triple, Tranche A still gets paid. AAA rating. So the rating agencies looked at this structure and said, okay, even if some of these mortgages are risky, the senior tranche is protected, it's safe. AAA, same rating as US Treasury bonds. Now let's be very clear about what just happened. The mortgages in that bundle, individually many of them would have been rated BBB, some BB, some even lower, but when you bundled them together and sliced them into tranches, the top slice got AAA. You took risk, moved it around, repackaged it, and suddenly it looks safer. This is called tranching, and mathematically it made sense. If you assume that defaults are random, that one person losing their job in Florida has nothing to do with someone losing their house in Nevada, then diversification works. The senior tranche really is safe. But here's the assumption buried in that model. Defaults are independent. What if they're not? What if there's something that makes all of them default at once? We'll come back to that. For now, just understand the basic inputs the rating agencies were using. Historical default rates on mortgages, the structure of the tranches, the diversity of the underlying loans. Plug those numbers into the model and out comes a rating. A, B, B, B. And the banks loved it because now they could do something extraordinary. They could take a pool of risky loans they'd never be able to sell to pension funds or insurance companies on their own, slice them up, get the top layer rated AAA, and sell it as a safe investment. The rating became a license to print money, and the agencies got paid every time. By 2006, nearly half of Moody's revenue came from rating these structured products. Half, not from rating IBM or Ford, from rating bundles of subprime mortgages. And here's the thing. The agencies weren't lying about the math. The models worked, the assumptions were documented, the methodology was published. If you were a smart analyst at Moody's in 2005 and someone asked you, is this AAA rated security really safe? You could show them the model, walk them through the probabilities, prove it on paper, and you'd believe it because the math was real. The inputs were historical, the logic was sound. Once you understand this, the collapse becomes inevitable, but not because the math was wrong, because of something else entirely, something that had nothing to do with numbers and everything to do with human nature. Let's talk about who gets paid. A mortgage broker sells you a home loan. Let's get specific about how this worked. You walk into a mortgage broker's office in Phoenix, Arizona in 2005. You want to buy a house for $400,000. You make $60,000 a year. You have $5,000 saved for a down payment. In a normal world, no bank would lend to you. You can't afford that house. You need to put down $80,000 and your monthly payment would still be around $3,000 a month, which is half your take-home pay. But the broker doesn't turn you away. Instead, they offer you an adjustable rate mortgage with a 2-year teaser rate. For the first 2 years, your payment is only $1,500 a month. You can afford that. What they don't emphasize is that in year 3 your payment jumps to $3,500 a month. But you don't think about year 3, you're thinking about owning a home now. The broker processes your loan and makes a commission. Here's the key. On a normal 30-year fixed mortgage, the broker might make 0.5%, so $2,000 on your $400,000 loan. But on this adjustable rate subprime loan, they make 2%. $8,000, 4 times as much. And here's the beautiful part for the broker. They don't hold the loan. They don't care if you default in 3 years. They sell your loan to a big bank within a week. They get their $8,000 and they never see you again. So what's their incentive? Sell the riskiest loan possible because it pays the most, and then immediately get rid of it. Now that loan gets sold to a bank. Let's say it's Lehman Brothers. Lehman bundles your loan with thousands of others. They got 2,000 mortgages totaling $800 million. They create tranches, get them rated, and sell them as securities. But here's the thing, to sell these securities, they need ratings, and not just any ratings, they need AAA, because pension funds, insurance companies, foreign banks, they're only allowed to buy investment grade securities. If it's rated BBB or lower, most institutional investors can't touch it. It's in their charter, their legal requirements. So Lehman needs AAA, or they can't sell the security, or they have to sell it at a massive discount. This is where it gets interesting. Lehman calls Moody's. They say, we have this $800 million mortgage-backed security. We need you to rate it. Moody's assigns a team, they analyze it, and they come back and say, we'll give the senior tranche a AA rating, not AAA. AA. Lehman's disappointed because AA means they'll have to offer a higher interest rate to sell it, which means less profit. So they call Standard & Poor's, S&P, analyze the same security and says, we'll give it AAA. Lehman says, great, we'll go with you. They pay S&P $500,000, get their AAA rating, and sell the security. Now what just happened? Moody's lost the business. They said AA, their competitor said AAA, and the client went with the competitor. Next time Lehman calls, Moody's knows this. So when they analyze the next deal, which is similar to the last one, what do? They could stick to their standards and say AA again, but they know they'll lose the deal. Or they can look at their model and say, well, maybe we were too conservative last time. Maybe we can tweak this assumption here, adjust this parameter there, and get to AAA. And that's what they do. Because if they don't just lose one deal, they lose Lehman as a client entirely. Lehman will take all their future business to S&P. This happened thousands of times, and it's not just about Lehman. Every bank on Wall Street was doing this. Goldman Sachs, Morgan Stanley, Bear Stearns, Merrill Lynch. They were all creating mortgage-backed securities. They all needed AAA ratings, and they were all shopping between agencies. By 2006, Moody's was rating a new mortgage-backed security every 11 minutes during business hours. Think about that. Every 11 minutes, a team of analysts had to review hundreds of pages of documentation, thousands of individual mortgages, build a model, assign a rating. That's not careful analysis. That's a rubber stamp factory, and the money was incredible. In 2006, Moody's made $900 million in profit from rating structured products. That's not revenue, that's profit. Their stock price went from $10 in 2000 to $70 in 2007. Analysts at Moody's got bonuses based on how many deals they rated. The more deals you rate, the bigger your bonus. So what's your incentive as an analyst? Rate deals quickly, rate them favorably so you keep clients, move on to the next one. Nobody got bonuses for being conservative. Nobody got promoted for saying this security is too risky. And here's what makes this so insidious. If you were an analyst at Moody's in 2006, you weren't lying. You genuinely believed your models. Your boss would show you the historical data. Mortgage defaults have averaged 2% for 50 years. We're diversifying across thousands of loans across different states, different types of borrowers. The math says the senior tranche is safe. And you'd look at that math and think, yeah, that makes sense. Because it did make sense on paper if the future looked like the past. The problem is that the past didn't include an environment where every incentive in the system was pushing toward more risk. This is the key. No one had to commit fraud. They just had to follow the rules. The rules said use historical data. The historical data said mortgages don't all default at once. So the model said this is safe, and the agencies believed it because the math worked. But here's what the math didn't capture: incentives. When you pay mortgage brokers more for riskier loans, they sell riskier loans. When you let banks bundle those loans and get them rated AAA, they create more securities. When you let rating agencies compete for business, they compete by being lenient. And when investors see AAA ratings and don't look deeper, they buy without asking questions. Every single person in this chain was acting rationally, following the rules, doing their job, but the system as a whole was broken. And here's the worst part: no one person could stop it. If you were an analyst at Moody's and you said we need to be more conservative, your boss would say our competitors aren't, we'll lose market share. If you were a banker and you said we should stop creating these securities, your CEO would say our competitors are making billions, we'll fall behind. If you were an investor and you said I don't trust these ratings, your clients would say everyone else is buying them, why aren't you? The system rewarded participation and punished caution. And once it started, it couldn't stop because stopping meant losing. By 2005, the rating agencies were making record profits. Moody's stock price increased 340% in 4 years. Analysts got bonuses for rating more deals faster. And the models kept saying everything was fine because the models were backward looking. They used historical data on defaults, and historically mortgages didn't default much. But that data was from a different era. An era when banks kept the mortgages they made, when brokers had skin in the game, when loans were underwritten carefully. Now the broker sells the loan immediately, the bank bundles it, and sells it the same week. The rating agency rates it and moves on to the next deal. No one holds the risk. No one. It's been packaged, sliced, rated, and sold to someone who thinks they bought safety. And when that person is a pension fund in Sweden or an insurance company in Japan, they're 10,000 miles away from the guy in Nevada who took out a subprime loan he can't afford. They'll never meet, they'll never speak, but their fates are now linked. And the rating, that single letter AAA, is the only thing connecting them. This is the machine, and by 2006 it was running at full speed. But it was about to hit a wall that nobody saw coming. From 1987 to 2006, home prices in the United States rose every single year. Not in most places, everywhere. California, Florida, New York, Kansas, it didn't matter. Prices went up. On average, home prices doubled during that period. In some hot markets like Las Vegas or Phoenix, they tripled or quadrupled. And that fact, that simple historical fact, was the foundation of the entire system. Because if home prices always go up, then mortgages are safe. If someone can't make their payments, they just sell the house, pay off the loan, walk away clean, no default, no loss. And if 1 million people have mortgages and home prices always rise, then even if some people struggle, the system holds. Every model, every rating, every A security, all of it depended on one thing. Home prices never fall nationwide. Sure, individual cities might have a bad year, Detroit, sure, but the entire country? That hadn't happened since the Great Depression. Until 2006, home prices stopped rising, not crashing yet, not collapsing, just slowing. In Nevada, Arizona, Florida, the markets that had exploded the fastest, sales start to stall. Here's what happened. Developers have been building like crazy. In Phoenix alone, they built 30,000 new homes in 2005, but they built based on demand that was fueled by speculation. People were buying homes they couldn't afford because they assumed prices would keep rising. They'd buy a house, wait a year, sell it for 20% more, pocket the profit. But once prices stopped rising, the speculators disappeared. No one wanted to buy anymore. Suddenly, there were 30,000 empty new homes in Phoenix and more being built every day. Inventory builds up. You got houses sitting empty for months. Sellers start to panic. They drop their prices just 5% just to attract buyers. And here's where the math gets interesting. Remember that guy in Phoenix who bought a $400,000 house with $5,000 down? He actually borrowed $395,000. If his house drops in value by 5%, it's now worth $380,000. He owes $395,000, but the house is worth $380,000. He's $15,000 underwater. Now his teaser rate expires. His monthly payment was $1,500. Now it's $3,500. He can't afford that. Normally he'd refinance and get a new loan with a lower rate, but no bank will give him a new loan because his house is worth less than what he owes. He's stuck. So he tries to sell, but he can't get $395,000 for it. The most he can get is $380,000. If he sells, he still owes the bank $15,000 plus he has to pay real estate commissions, closing costs, maybe another $20,000. So selling costs him $35,000 he doesn't have. His choices are keep paying $3,500 a month, which he can't afford, pay $35,000 he doesn't have to sell, or default. What does he do? He defaults. And he's not alone. Thousands of people in Phoenix are in the exact same situation. All at once, when one person defaults and the bank forecloses, it's just one house on the market. But when 1,000 people default in the same neighborhood, 1,000 foreclosed homes hit the market simultaneously, and banks are desperate to sell them. They'll take any offer, $350,000, $300,000, whatever they can get. Each sale becomes the new market price, which means everyone else who bought at $400,000 now sees their neighbor's house sell for $300,000. Suddenly they're not $15,000 underwater, they're $100,000 underwater. And if they were on the fence about defaulting, well, now the decision is easy. Why keep paying a mortgage on a house that's worth half what you owe? Default rates spike. By early 2007, defaults were spiking across the entire Sun Belt. Subprime mortgages that were supposed to default at a rate of 2%, according to historical averages, were defaulting at 10%, then 12%, then 15%. In some securities, 20% of the underlying mortgages went bad. And remember those tranches? Tranche C, was supposed to absorb the first 5% of losses. Tranche B would cover the next 10%. Tranche A was protected by 15% worth of lower tranches. But when 20% of loans default, the losses blow through C, blow through B, and hit A. The AAA rated tranche starts losing money. And here's what the models never captured. One default leads to another. It's not random. When your neighbor defaults, your house value drops. When 100 neighbors default, your house value craters. When you lose your construction job because no one's building new homes anymore, you default. When the local economy collapses because construction was 20% of all jobs, everyone defaults. The defaults feed on themselves, they multiply, they cascade. This is called correlation. And the rating agency models assumed correlation was low. They assumed defaults were independent events, and they were catastrophically wrong. And the rating agencies, the models they built, the AAA ratings they'd given out like candy, they never saw it coming because the models were built on a world where this didn't happen. By early 2007, defaults were spiking. Subprime mortgages that were supposed to default at a rate of 2% were defaulting at 10%, then 15%, then 20%. And the securities built on those mortgages, the AAA rated tranches, they were supposed to be safe, protected by layers of lower rated tranches that would absorb the losses. But when 20% of the underlying loans default, there aren't enough lower layers, the losses cut through, and the investors who bought those AAA rated securities, pension funds, insurance companies, foreign banks, they start losing money. At first it's small, a few million here and there, then it's billions. And the rating agencies start downgrading, but not fast enough because they're using the same models, the same backward-looking data, and they don't want to admit the models were wrong, because if the models were wrong, then every rating they'd ever given was suspect. By mid-2007, the market starts to freeze. No one wants to buy these securities anymore because no one trusts the ratings. And if you can't trust the rating, you have to analyze the security yourself. But these securities are complex, thousands of mortgages, hundreds of pages of documentation. You'd need weeks to understand one deal, so investors just stopped buying. And banks that had planned to sell these securities, that had already created them, already borrowed money against them, they're stuck. They're holding billions of dollars in assets they can't sell, assets that are rapidly losing value. And because banks borrow short-term money to fund long-term investments, when the value of those investments drops, they need more collateral. But they don't have it, so they start selling other assets, anything they can, which drives prices down further. And the rating agencies finally, belatedly, desperately, start mass downgrades. In July 2007, Moody's downgrades 399 securities in a single day, then 691 more the next week. By the end of the year, tens of thousands of securities have been downgraded. Investors are panicking, not because they didn't understand the risk, but because they thought someone else had understood it for them. They trusted the rating, and the rating was a lie. Not a deliberate lie, not fraud, just a model that worked in one world applied to a different world. By the time anyone noticed, it was already too late. And what came next would prove that the problem wasn't just about mortgages or even about banks. It was about something much deeper. September 15, 2008, Lehman Brothers files for bankruptcy, $613 billion in debt, the largest bankruptcy in US history. But it's not just Lehman. Bear Stearns collapsed in March. Merrill Lynch had to be bought by Bank of America in an emergency weekend deal. AIG, one of the world's largest insurance companies, needed an $85 billion government bailout just to survive the next day. Within hours of Lehman's announcement, global markets collapse. The Dow Jones drops 500 points in a single day. Credit freezes. And this is where most people don't understand what happened. It's not just that banks stopped lending to homeowners. They stopped lending to each other. Here's why that matters. Banks don't keep all their money in a vault. They lend it out. That's how they make money. But they need to keep some cash on hand for daily operations, for when depositors want to withdraw money, for when other businesses need short-term loans. So every night, banks borrow money from each other for 24 hours. It's called the overnight lending market. Bank A has extra cash. Bank B needs some. Bank A lends to Bank B overnight at a tiny interest rate. Bank B pays it back the next morning. It's boring routine. It happens every single night for billions of dollars. until September 2008. Then it stops. Why? Because no one knows who's holding what. Every bank knows they have toxic mortgage-backed securities on their books. They know some of them are worthless, but they don't know which other banks are in trouble. Is Bank B about to go bankrupt like Lehman? If I lend them $1 billion overnight and they collapse before morning, I never get that billion back. So banks stop trusting each other. If Bank A won't lend to Bank B, then Bank B can't make payroll tomorrow, can't process withdrawals, can't fund operations. Perfectly healthy banks were hours from failure simply because they couldn't borrow overnight. This is what people mean when they say credit markets froze, the plumbing of the financial system stopped working, and it spreads beyond banks immediately. General Electric, one of America's largest companies, couldn't borrow money to make payroll. Cities couldn't roll over their short-term debt. Alabama had to delay road construction projects. California started paying vendors with IOUs instead of cash. The University of California system couldn't access credit markets to fund its operations. These are not financial companies. These are municipalities, corporations, institutions that had nothing to do with subprime mortgages, but they all depended on functioning credit markets. And suddenly those markets didn't function. The job losses were catastrophic. 8.7 million jobs lost between 2007 and 2009. The unemployment rate went from 5% to 10%. But those numbers don't capture the reality. If you were a construction worker in Nevada, your industry didn't shrink, it vanished. Construction employment in Nevada dropped 70%. If you worked in manufacturing in Michigan, entire factories closed permanently. 40,000 people worked for General Motors in Flint, Michigan in 2000. By 2009, there were 7,000. Towns that had been built around manufacturing saw their tax base disappear, schools closed, police forces cut in half, 10 million homes foreclosed. Again, those are just numbers. Let me make it real. You're a family in Riverside, California. You bought your house in 2005 for $500,000. You put down 10%, you have a good job, you're making payments. Then the crisis hits. Your house is now worth $250,000. You owe $450,000. You're $200,000 underwater. You didn't do anything wrong. You didn't buy a house you couldn't afford. You didn't get a subprime loan. You have a regular 30-year fixed mortgage, but your house lost half its value. Do you keep paying a mortgage that's twice what your house is worth? A lot of people said no and walked away. Strategic default, they called it. Perfectly rational for the individual, catastrophic for the system. Pension funds lost trillions. CalPERS, California's public employee pension fund, lost $100 billion in 18 months. That's money that was supposed to pay retired teachers, firefighters, police officers. Some pension funds lost so much that they're still underfunded today, 15 years later, which means cities are still cutting services to make pension payments, which means retired public workers are getting less than they were promised. And the rating agencies, they're called before Congress in October 2008. The House Committee on Oversight and Government Reform, they put up emails on big screens, internal emails from Moody's analysts. One says, let's hope we are all wealthy and retired by the time this house of cards falters. Another says these deals could be structured by cows and we would rate them. The committee asked the obvious question. If you knew these securities were risky, why did you rate them AAA? And the answer from Raymond McDaniel, CEO of Moody's, is simple. We relied on the information provided to us. We used historical data. Our models didn't predict a nationwide decline in home prices because that had never happened before, all of which was true, but none of which mattered because the investors, the pension funds, the cities, the foreign banks, they didn't lose money because the agencies were dishonest. They lost money because the agencies were trusted, and that trust was misplaced. No one is criminally charged. Not a single rating agency executive goes to jail. Not a single analyst is prosecuted because no laws were broken. And this is important to understand. The models were disclosed. If you really wanted to, you could have requested Moody's methodology document. It was 400 pages of mathematical formulas and assumptions. It was public. The conflicts of interest were known. Everyone in the industry knew that issuers paid for ratings. It wasn't a secret. The assumptions were documented. The models clearly stated they were based on historical default rates and assumed defaults were independent. Investors could have read the methodology. They could have questioned the ratings. They could have hired their own analysts to dig into the underlying mortgages, but they didn't. Why not? Because the entire system was built on the assumption that someone else was doing that work. The pension fund manager in Norway assumed the rating agency had done rigorous analysis. The rating agency assumed the bank had properly underwritten the mortgages. The bank assumed the mortgage broker had verified the borrower's income. The mortgage broker assumed the borrower would be able to refinance if they got in trouble. Everyone assumed someone else was checking. And when everyone assumes someone else is checking, no one checks. In the end, the US government steps in with unprecedented force. September 2008, Treasury Secretary Henry Paulson announces the Troubled Asset Relief Program TARP, $700 billion to buy toxic assets from banks, the biggest government intervention in markets in American history. But that's just a headline number. The Federal Reserve did far more. They lowered interest rates to zero. They created emergency lending facilities. They bought mortgage-backed securities directly. They guaranteed money market funds. They extended dollar swap lines to foreign central banks. When you add it all up, the Fed committed more than $7 trillion in loans, guarantees, and asset purchases. $7 trillion. Why? Not to save the banks, although that's what it looked like. To save the system. Here's what would have happened without intervention. Lehman failed and credit markets froze. If the government hadn't stepped in, Bank of America would have failed within a week. Then Wells Fargo, then JP Morgan. Every major bank would have collapsed in a cascade. When banks fail, depositors lose their money. The FDIC insures deposits up to $250,000, but the FDIC only had about $50 billion in reserves. If all the major banks failed simultaneously, the FDIC couldn't cover it. Millions of people would have lost their life savings overnight. And it gets worse. When banks fail, businesses can't make payroll because they can't access their bank accounts. Literally, workers show up Monday morning and the company says, "We can't pay you because our bank collapsed." Within 2 weeks, you'd have mass unemployment, not because companies were failing, but because they couldn't process payments. Pension funds would have been wiped out completely. Social Security would have continued, but most Americans rely on Social Security plus a pension or 401k. If the pension disappears, retirees are living on Social Security alone, which averages about $1,800 a month. Try living on that. The government absorbed the damage not because they wanted to reward banks, but because the alternative was the collapse of the entire economy, possibly for years. During the Great Depression, unemployment hit 25% and stayed there for a decade. That was before we had a globally integrated financial system, before we had just-in-time supply chains, before we had electronic payments for everything. A modern version of the Great Depression would have been unimaginably worse. So the government stepped in and essentially said, "We'll take the losses, we'll stabilize the system, we'll deal with the consequences later." The consequences? National debt went from $9 trillion before the crisis to $20 trillion by 2016. That's debt taxpayers are still paying interest on today. And the people who created the crisis, the brokers who sold the fraudulent loans, and yes, some of them were straight fraud, lying about borrowers' incomes, forging documents. Some went to jail, but very few. Most just lost their jobs and moved on. The banks that bundled the loans, they took government bailouts, paid them back with interest, and went back to making profits within 2 years. Goldman Sachs paid back their bailout money and gave out $16 billion in bonuses in 2009. The rating agencies, Moody's stock dropped during the crisis, but recovered fully by 2013. The agencies had to pay some fines. Moody's paid $860 million. S&P paid $1.5 billion. Sounds like a lot until you remember they made billions in profits during the boom. The analysts who rated the securities, most kept their jobs. Some moved to other firms. Some started consulting companies advising on, ironically, how to value complex securities. The system wasn't designed to punish them. It was designed to let them profit when things worked and let someone else pay when things didn't. And the someone else was taxpayers, homeowners who lost their houses, workers who lost their jobs, retirees who saw their pensions cut. People who had nothing to do with creating the crisis absorbed most of the damage. But this raises the question that nobody wants to ask. What was the lie? Because if everyone followed the rules, if the math was real, if no laws were broken, then what exactly went wrong? The lie wasn't the ratings. The ratings were just models, assumptions, probabilities based on historical data. They were wrong, but they weren't lies. It wasn't the agencies. They were businesses following incentives, competing for clients, doing exactly what the market rewarded them for doing. It wasn't even the banks. They were optimizing, finding ways to turn risky assets into safe ones, to expand credit, to maximize returns. All of it was legal, all of it was disclosed, all of it followed the rules. So what was the lie? The lie was the promise underneath it all. The promise that risk could be removed. That if you sliced it thin enough, modeled it precisely enough, diversified it broadly enough, risk would disappear. But risk doesn't disappear. It moves. You can move it from the bank to the investor, from the investor to the insurer, from the insurer to the taxpayer, but you can't remove it. And once you build a system on the assumption that risk has been removed, you stop preparing for it, you stop holding capital reserves, you stop asking questions, you stop checking because the model says you're safe and the rating confirms it and everyone else is doing it, so you do it too, until something breaks. And when it breaks, you realize the risk was never gone, it was just hidden, repackaged, relabeled, sold as safety. And the real lie, the foundational lie, was that a letter could capture reality. That a single grade assigned by analysts using backward-looking models could tell you everything you needed to know. That you didn't need to think, didn't need to question, didn't need to understand, because someone else already had, but no one had. The agencies were guessing, the banks were optimizing, the investors were trusting, and the system, the beautiful, efficient, mathematically rigorous system, was built on a foundation that couldn't hold. Not because anyone was evil, not because anyone was stupid, but because the incentives were wrong. And once the incentives are wrong, collapse isn't a possibility, it's a certainty. The $500 billion lie wasn't about fraud, it was about belief. Belief that systems can be perfected, that risk can be quantified away, that complexity equals safety. And once you believe that, you stop seeing what's right in front of you until it's too late. So what was the lie? This is the question that matters, because if we don't understand what actually failed, we can't prevent it from happening again. And spoiler alert, we haven't prevented it. It wasn't the ratings themselves, those were just models, mathematical constructs, assumptions plugged into formulas. They were wrong, but they weren't intentional deceptions. No one sat in a room and said, let's deliberately give AAA ratings to securities we know are worthless. The analysts believed their models. They had to, because the models were all they had. And those models said that based on 50 years of historical data, based on diversification principles, based on structural protections built into the tranches, these securities were safe. On paper, they were safe. In a world that looked like the past, they were safe. But the world had changed and the models hadn't noticed yet. It wasn't the agencies either, not in a moral sense. Yes, they were businesses following incentives, competing for clients, doing exactly what the market rewarded them for doing. But put any business in that position and they'd behave the same way. If your competitor is winning clients by being more lenient and you lose revenue by being conservative, you either match the competition or you die. That's not a moral failing. That's how competitive markets work when the incentives are broken. The agencies were in an impossible position. Be conservative and lose business, or be lenient and keep clients. They chose survival. Most businesses would. It wasn't even the banks. They were optimizing, doing what banks do, finding ways to turn assets into securities, to expand credit, to maximize returns for shareholders. And expanding credit isn't inherently bad. Credit is how economies grow, how people buy homes, how businesses expand. The problem was they found a way to expand credit without holding the risk. All of it was legal, all of it was disclosed, at least in theory. The rating methodologies were published, the prospectuses were available, the conflicts of interest were known. If you really wanted to understand what you were buying, the information existed, but it was buried in thousands of pages of technical documents written in financial jargon that most people couldn't understand. And even if you could understand it, you'd have to analyze it for every single security, which would take weeks per security, and you're trying to invest hundreds of millions of dollars across thousands of securities, It's functionally impossible. So people relied on the rating. The rating was supposed to be the summary, the shortcut, the expert opinion that saved you from having to become an expert yourself. So what was the lie? The lie was the promise underneath everything. The promise that risk could be removed, not reduced, not managed, but actually eliminated. That if you were smart enough, if you sliced it thin enough, if you modeled it precisely enough, if you diversified it broadly enough, risk would simply disappear. Think about what tranching was really claiming. You take a pool of risky loans, individually each loan has maybe a 5% chance of default, but you bundle 1,000 of them together and slice them into layers, and suddenly the top layer has a 0.01% chance of loss. How is that possible? Where did the risk go? It didn't go anywhere. It moved. You moved it from being spread evenly across all the loans to being concentrated in the bottom layers. The bottom tranches absorb all the risk, so the top tranches have none. That's the theory, but here's the thing, the bottom tranches still exist. Someone still owns them. The risk is still in the system. It's just been shuffled around and relabeled. But the market acted as if the risk in the AAA tranches had actually been destroyed. Pension funds bought them as if they were equivalent to treasury bonds. They weren't. Treasury bonds are backed by the US government's ability to tax and print money. Mortgage-backed securities are backed by people making monthly payments. And if those people lose their jobs or their home values crash, the payments stop. These are fundamentally different things, but they had the same rating, so the market treated them the same. This is magical thinking. And once you build a system on magical thinking, once everyone believes that risk has been removed, you stop preparing for it. Banks didn't hold capital reserves against these AAA securities because they were rated AAA. Why hold reserves against something that's guaranteed safe? That capital could be used to make more loans, generate more fees, increase returns. Pension funds didn't diversify away from them because they were already considered the safe part of the portfolio. They were supposed to be the ballast, the stability, the thing that doesn't lose money. Regulators didn't scrutinize them because the rating agencies had already approved them. Why have the government duplicate work that the experts already did? Everyone in the system reduced their defenses because they believed the risk was gone. The rating itself became a form of alchemy. You take subprime mortgages, loans to people with bad credit, low incomes, no down payments, people who in many cases lied on their applications or were encouraged to lie by brokers who didn't care because they were selling the loan anyway. Individually, these are obviously risky. Everyone knows they're risky. The interest rates are higher precisely because they're risky. But you put them in a pool, tranche them, model them, and get them rated, and now the top layer is AAA. You transformed lead into gold, except you didn't. You just convinced everyone that lead was gold because you painted it gold and got someone with authority to certify it was gold. The certification became more important than the underlying reality. This is a theme that keeps repeating in financial crises. In the South Sea bubble, people bought shares in companies that had no actual business plan because the shares had fancy certificates and important people endorsed them. In the dot-com bubble, companies with no revenue and no path to profitability were valued at billions because they had com in their name, and venture capitalists backed them. In the housing crisis, securities backed by subprime mortgages were considered safe because they had AAA ratings. The pattern is always the same. People stop looking at the underlying asset and start trusting the label. And this is where the real lie lives. Not in any single action, but in the fundamental assumption that a letter grade assigned by analysts using backward-looking models can tell you everything you need to know about a complex financial instrument, that you don't need to think, don't need to question, don't need to understand the actual assets underneath because someone else has done that work for you. But no one had done that work. The agencies were running models based on data that didn't account for the new reality. The banks were securitizing mortgages faster than anyone could analyze them properly. The investors were buying based on ratings without reading the prospectuses, and even if they read them, they wouldn't have had time to verify the claims. The entire chain had no one actually looking at the underlying reality. Everyone was looking at someone else's summary of the reality, and each summary was based on assumptions that were becoming less true by the day. It's like a game of telephone where the original message was this specific person in Nevada with a 600 credit score and a stated income loan might have trouble making payments when their rate adjusts in 2 years. And by the end of the chain, the message is this: AAA rated security is as safe as a US Treasury bond, and you can buy it with leverage and use it as collateral for more borrowing. The information degraded at every step, but everyone acted as if they had perfect information. And here's what makes this so dangerous. The failure wasn't because people were stupid or evil. If it was about stupidity or evil, we could fix it by hiring smarter people or prosecuting bad actors. The failure was structural. The mortgage broker wasn't evil for selling a risky loan. They were responding to incentives. They got paid more for risk, and they transferred that risk immediately so they never felt the consequences. It's not evil to do what you're paid to do. The rating analyst wasn't stupid for believing their model. The model was built by PhDs using decades of historical data and sophisticated mathematics. The best minds in quantitative finance built these models. The problem was the data didn't account for what happens when everyone in the system is incentivized to take more risk simultaneously, when the very act of spreading risk creates more risk because it removes the incentive to be careful. The pension fund manager wasn't negligent for buying AAA rated securities. They were following their legal mandate. Their charter said invest only in investment grade assets. AAA is the highest investment grade, so they bought it. They were doing their job correctly according to the rules. No one person could have stopped it because stopping required going against every incentive in the system. If you were a mortgage broker in 2005 and you said, I'm only going to sell prime mortgages with full documentation and verified income, you'd make half the commission of your competitors. Your boss would ask why your production is down. You'd get fired and replaced with someone willing to sell subprime. If you were a rating agency and you said we're going to be much more conservative than our competitors, we're going to assume defaults are correlated, we're going to require more subordination in the tranches, you'd lose clients. Your revenue would drop, your stock price would fall, shareholders would demand changes, the board would replace you. If you were a bank and you said we're not going to securitize subprime mortgages, we think the risks are too high, you'd watch your competitors make billions in fees while you stagnated. Your traders would leave for other banks. Your market share would decline. You'd be seen as behind the times, not innovative, missing opportunities. If you were an investor and you said, I don't trust these AAA ratings, I'm going to avoid mortgage-backed securities and stick to traditional bonds, you'd underperform your peers for years. From 2003 to 2007, mortgage-backed securities outperformed. Your clients would leave. Your fund would shrink. You'd lose your job. The market punishes caution during bubbles. This is why bubbles are so dangerous. The rational individual decision is to participate even if you suspect it's a bubble, because fighting the bubble early destroys your career. The system rewarded risk-taking right up until the moment it collapsed, and then it punished everyone, even people who hadn't taken risks, even people who had been cautious, because when the system fails, it fails for everyone. This is systemic risk. This is why regulators are supposed to care about it. Individual risk is fine if you make a bad investment and lose money that's on you. Systemic risk is different. When your failure takes down the entire financial system, it's not just your problem anymore. This is why the answer isn't just better regulations or stricter rules. Don't get me wrong, we need those too. We need higher capital requirements so banks can absorb losses. We need better stress testing so we catch vulnerabilities before they explode. We need more transparency so investors can actually understand what they're buying. But those are band-aids. The deeper problem is that we built a financial system that allows people to profit from risk without bearing the consequences of that risk. This is called moral hazard, and it's poison to a market economy. In a functioning market, if you take a risk and it pays off, you profit. If you take a risk and it fails, you lose. That feedback loop is what makes markets work. It's what aligns incentives. You're careful about risk because you bear the downside. But in modern finance, we've broken that loop at multiple points. The mortgage broker profits from the risk but sells it immediately. The bank profits from the risk but securitizes it and sells it. The rating agency profits from rating the risk but has no stake in whether it performs. The investor buys based on the rating without understanding the risk. And if it all goes bad, the government steps in to prevent collapse. which means taxpayers bear the ultimate risk. At every step, the person making the decision isn't the person who bears the consequences. And when you separate decision making from consequences, you get bad decisions. That's not a moral judgment, it's just game theory. If I can make money from risk and you pay the price when it fails, I'm gonna take more risk than I should. This is basic economics, but we structured our financial system to violate it systematically. And here's the real kicker, we haven't fixed this. The rating agencies still get paid by issuers. They still compete for business by being lenient. Banks still securitize loans. They still create complex products that are hard to understand. The models still use historical data. They're more sophisticated now. They account for more variables, but they're still backward looking. Yes, there are more regulations now. Dodd-Frank, Volcker Rule, stress tests, capital requirements, liquidity ratios. But the fundamental structure hasn't changed. We're still operating on the assumption that risk can be accurately modeled and managed through financial engineering. We still trust that ratings capture reality. We still believe that complex securities can be safely owned by investors who don't fully understand them. The belief that risk can be removed instead of moved, that's still there. It's baked into how we think about finance. We still act as if diversification and structuring can make risk disappear. We still treat mathematical models as if they're reality rather than simplified approximations of reality. We still trust credentials and complexity more than we should. And we still have a system where the people taking risks aren't the people bearing them until we fix that fundamental misalignment. Until we rebuild the link between decisions and consequences, we're vulnerable to the same kind of collapse. Maybe not in mortgages next time, maybe in corporate debt, or student loans, or crypto, or sovereign bonds. The specific asset class doesn't matter. The pattern is what matters. And once you build a system on the assumption that risk has been removed, that complexity equals safety, that experts with models know better than common sense, collapse isn't a possibility, it's a certainty. Not today, not next year, but eventually, because risk doesn't disappear. It doesn't get destroyed by financial engineering. It just moves, it hides, it accumulates. And then one day something changes. Some assumption that everyone relied on turns out to be wrong, and all that hidden risk reveals itself at once. That's what happened in 2008. That's what happened in 2000, in 1998, in 1987, and 1929. It's the same pattern every time. Build complexity, trust models, separate risk from consequences, reward optimism, punish caution, and wait. The waiting is the only variable. Sometimes it takes 5 years, sometimes 20, but it always ends the same way.